We had highlighted in our outlook at the back end of last year the 7 key risks that we foresee. They're still present. One of them is increased indebtedness as a result of the increased fiscal stimuli that have been deployed to help the recovery. And that in the long term could lead to lower growth prospects. This is something that's in a time horizon of 4, 5, and 10 years, really. The second one is a pandemic relapse risk. This is going to be omnipresent, and this is a risk that the market will need to learn to live with. There's the omnipresent geopolitical risks, which to us are something that needs to be kept in focus, notably China versus US and China versus rest of the world as some of the geopolitical tensions. Fourth risk, the fiscal stimuli. Clearly, because they're instrumental to the recovery, execution risk from implementation of this fiscal stimuli is something that investors need to watch out for. On to the final 3 of the 7 risks. Those are more apparent to us, more of an area of focus. They are firstly taxation, increased risk of taxation, both on households and on corporates, as a way to part fund the fiscal stimuli. We think this is something that is already being factored by some geographies, like the UK has flagged that, the US is talking about it. This is something investors will need to capture into their expectations. We have already increased our expectations of higher tax rates across all companies that we're invested in the Global Portfolio Trust to anticipate these developments. The other one is asset price bubbles forming. So clearly, the low rates environment, the plentiful liquidity that there is in the market is pushing for more risk-taking. And we are seeing some localized asset price bubbles. They are localized, so it's important to really remain disciplined as investors and focus on the framework on valuation that is consistent to ensure we don't get caught up into these asset price bubbles. And finally, inflation. This is going to be an ongoing debate as to whether inflation is transitory or whether there's a sustained pickup. Clearly for us, the importance of not making strong conclusions at this stage, given that we're going through what is a low base effect, as well as frictional pressure on inflation as economies reopen at different speeds, and as we're met with some bottlenecks across the supply chains, whether it's the logistics or whether it's some component shortages. So for us, really, it's a case of continuing to keep an eye on inflation. We're expecting a loss of momentum into the second half, and as the base effect washes out, we're still working on a medium-term assumption of a benign inflationary environment. And what we're looking for is wage inflation, given that that's the biggest contributor to inflation ultimately. We're looking at whether there are signs of sustained pickup in wage inflation. Now, at the moment, the picture there remains comfortable. There aren't any major acceleration at this stage.